everyone, welcome to my channel. I'm Doris and I'm here to share with you about my account. Today my account earned $1,551. Today also the market, the Dow Jones Industrial Average and S&P 500 fell for the 3 straight times. Number 3, U.S. economic data and analyst comments. Let's first take a look at my account. My account, including the aftermarket, has earned $1,438, which is a gain of 1.65%. So right now, the net asset of my account is $88,761.89. Today, SQQQ rose for 3.13% to 48.82, and I have 1,300 shares of this. So today I gained $1,248 in total. As for DRV, it rose 1.39% to 46.01. And I have 500 shares of this DRV, so I gained a total of $190. Since both of the ETF are bear ETF, let's take a look at the market, how it's doing today. Today, Dow Jones Industrial Average decreased for 0.76% to 33,044.56. Nasdaq Composite decreased for 0.96% to 10,852.27. And S&P 500 decreased for 0.76% to $3,898.85. Looking at the industry heat map, semiconductors first caught my eye, as well as specialty industrial machinery and capital markets. They all decreased for more than 2.4%. On the other hand, the internet content and information rose for 2.11%, and the rest of the industries varied and mostly performed a loss today. U.S. stocks closed lower on Thursday, with the Dow and the S&P 500 both recording their third straight sessions down. Despite the signs of slow inflation, investors are concerned that the Fed will maintain its aggressive rate hike policy and lead to a recession. The Boston Fed governor supports a slower rate hike to above 5%. In recent days, optimism in U.S. stocks market in early 2023 has faded, with investors worried that the lagging effect of the Fed's aggressive rate hike has begun to hit the market. David Donabedian, Chief Investment Officer at CIBC Private Finance America, said, "Housing market is clearly in recession and manufacturing is hovering on the brink of recession. And entering 2023, consumers will be more cautious, and over time we'll see some signs that the job market falters. We believe the probability of a moderate recession in the U.S. and the rest of the world will be above 50% this year." Markets are focused on Fed officials' speeches to gauge the future direction of monetary policy. Fed Vice Chairman David Brainerd said on Thursday that even with progress on inflation, there will be high interest rates ahead. She said the Fed Open Market Committee is likely to raise its benchmark interest rate by another 25 basis points to its target range of 4.5% to 4.75% on February 1st. Boston Federal Reserve Bank President Susan Collins, she advocates the Fed raise interest rates at a smaller pace. Given the interest rate in the restricted area and the current indicators show we may be near the peak, I think from the initial rapid pace to a more slower pace is appropriate, she said in a written speech on Thursday. The current more cautious suggested interest rates will let us better cope with the competitive risk of monetary policy. The Fed slowed the rate of tightening after 4 consecutive interest rates of 75 basis points, raising its target range of 50 basis points to 4.25% to 4.5% last month. A dot chart of the rate hike path released at the meeting showed that Fed officials were predicting that rates would rise to 5.1% and remain at the level for the 4 years, calling support for this prospect. As a monetary policymaker, restoring price stability remains our top priority, she said. Therefore, I expect further interest rates, probably just above 5%, and then holding on for a while. In an interview at Davos, JP Morgan CEO Jamie Dimon reiterated that core inflation remains high is unlikely to dissipate in the short term, so the policy will certainly be above 5%. If the U.S. experiences a slight recession, the interest rates could even rise to 6%. Philadelphia Fed Chairman James Harker reiterated on Wednesday that he supports the Fed to slow the pace of rate hikes to 25 basis points on signs that high inflation is cooling. Among overseas central banks, Europe's Central Bank President Christine Lagarde said in Davos on Thursday that European inflation remains too high, and policymakers will not be easing efforts to bring price growth back to target levels. U.S. economic data and analyst comments. The labor market reported that the number of U.S. initial job claims for state unemployment benefits stood at 190,000 in the week ended January 14th, the lowest level since the week ended September 24th. Market expectations of 214,000 versus 205,000 last. Continuing claims for the week ended January 7th were 1.647 million versus 1.66 million expected versus 1.64 million last week. For the 4-week move for claims was 206,000, up from 212,500 previously. A separate data from the Labor Department fell 1.4% in December to 1.38 million housing starts on an annualized month-to-month, compared with an expected decline of 4.8% and a 0.5% decline. The total number of U.S. construction permits was 1.33 million in December, the lowest since June 2020. 1.37 million buildings are expected, compared with 1.341 million buildings previously. Building permits fell 1.6% in December month-on-month, compared with a 1% increase expected, and an 11.2% decline last. The Philadelphia Fed reported that the Philadelphia Fed Manufacturing Index was negative 8.9 in January, negative 11 expected, and negative 13.8 expected last. Among the components, the Philadelphia Fed Manufacturing Employment Index stood at 10.9, up from negative 1.8 last month. The Philadelphia Fed Manufacturing Price Payment Index was 24.5 in January, up from 26.4 last month. Philadelphia Fed Manufacturing Loading Index for January was 11.1, last negative 6.2. A Philadelphia Fed Manufacturing Price Index of 29.9 in January, up from 24.3 last month. The Philadelphia Manufacturing New Orders Index was negative 10.9, negative 25.8 last month. The Philadelphia Fed's overall local manufacturing activity continued to decline. The agency reported that overall manufacturing activity in the region continued to decline, based on companies responding to the January Manufacturing Business Outlook survey. The survey's overall activity, new orders and shipment indicators rose from the previous month, but the first two indicators remained negative. The employment index rebounded. These companies reported overall price increases. The price acquisition index remained high, while the paid price index returned to the average level. Most future indicators are positive, but expectations for future growth over the next 6 months are not universal. After release of the data, some of the agencies published brief comments. The agency said the U.S. jobless claims last week showed a strong job market. U.S. jobless claims unexpectedly fell last week to their lowest level since September, underscoring the strong labor market and the reluctance of many businesses to cut jobs. But the agency also noted that the figures were particularly unstable and difficult to adjust seasonally around the holidays. Many economists expect layoffs to rise further in the coming months as the Fed continues to raise interest rates and keep rates high to crush the economy. On an unadjusted basis, California's initial unemployment claims have increased, but the numbers could be affected by state's severe flooding. The annualized number of December housing starts fell for the first time since 2009. The agency said housing starts fell in the fourth straight month in December, ending a disappointing ending a disappointing year for the housing sector. The housing market deteriorated rapidly last year after the Fed took its most aggressive rate hike since the 1980s. That sent mortgage rates soaring and many potential buyers squeezed out, prompting many builders to offer incentives in the hope of boosting demand. For the Philadelphia Fed's manufacturing index, analysts believe the survey shows that supply bottlenecks and the backlog are disappearing at fairly fast rates. Overall, manufacturing is slowing, but it is not surprising given the low whip effect of strong demand growth during the pandemic. Car manufacturing still supports the entire industry, but that momentum will fade by the end of the year. The inflation data are falling. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.